So picture this. It is 1982, and a 33-year-old investor goes on national television. Specifically, he goes on Wall Street Week, which was basically the most influential financial news program at the time.
Oh, absolutely. It was huge.
Right. And he looks directly into the camera, and he just bets his entire reputation and his clients' money on this catastrophic, unavoidable global depression. He is just absolutely certain it's happened.
And well, he was completely, devastatingly wrong.
So wrong. He lost so much money, he actually had to let his entire staff go. He had to borrow cash from his dad just to feed his kids.
Wow.
Yeah, it was bad. Yet somehow, that exact public humiliation became the secret formula for building a $150 billion empire. Welcome to our deep dive into the source material. Today, our mission is to figure out how an ordinary kid from Long Island built Bridgewater Associates, the world's largest hedge fund, out of his two-bedroom apartment.
It's just a phenomenal story, mostly because, it defies that conventional myth of the flawless financial genius, and we have a massive stack of sources for this deep dive today.
We really do.
Yeah, we're pulling from corporate biographies from Bridgewater, independent financial analyses, summaries of his best-selling books like Principles and the Changing World Order, and to balance it all out, some highly critical investigative journalism from the New York Times.
Okay, let's unpack this. How does a man who openly admits his biggest asset is his ability to fail repeatedly manage to generate over $55.8 billion in net gains for his investors?
That tension right there is the core of this entire deep dive, and it's exactly why this matters to you, the listener. Even if you don't care about hedge funds or Wall Street at all, his framework is universally applicable.
Right, because he treats everything as a machine, doesn't he?
Exactly. He treats life, markets, history, all of it as a repeating machine. Studying how he built that is essentially a masterclass in how to process overwhelming information without losing your mind.
So to understand the mechanics of that machine, we really have to look at his origins. He was born in 1949 to a jazz musician and a homemaker.
Yeah, not exactly a Wall Street dynasty.
No, not at all. But at age 12, he gets a job caddying at a golf course. And it's the early 60s, the stock market is booming, and he hears these golfers talking about stocks. So he takes his caddying money and buys his very first stock.
Which is Northeast Airlines.
Right.
And the rationale behind his purchase is just incredibly telling, mostly because it was, well, entirely illogical.
Oh, totally.
He bought it simply because it was under $5 a share. He just assumed a low share price meant he could buy more shares and make more money.
Completely flawed logic. But he got incredibly lucky. Northeast Airlines was actually on the verge of bankruptcy, but they got bought out of nowhere. The stock tripled overnight, and he was instantly hooked.
But that unearned win planted a pretty dangerous seed.
Exactly. It gave him this extreme confidence. Fast forward, he gets an MBA at Harvard, lands a job on Wall Street. But his temperament was a bit erratic. In 1974, he's at a New Year's Eve party, gets drunk, and physically punches his boss in the face.
Which is a career-ending move in almost any industry.
Yeah, you'd think so. So he gets fired. And in 1975, he retreats to his two-bedroom apartment and starts his own firm, Bridgewater. And he actually scrapes together some real success.
Right, consulting for companies like McDonald's?
Yeah, he helped them figure out how to stabilize the price of chicken so they could launch Chicken McNuggets.
Huh.
But all this early success breeds that extreme, almost blinding confidence again. Which brings us back to that 1982 disaster.
Right. And that television appearance was driven by his analysis of emerging market debt. He saw that Mexico was on the brink of defaulting on its loans.
And he thought it would cause a domino effect.
Exactly. He concluded this default would take down American banks and plunge the global economy into a massive depression. He was so confident that he positioned Bridgewater's entire portfolio to profit from a market crash.
Except central banks stepped in, restructured the debt, and the markets rallied aggressively. The depression never happened. He was just financially ruined. To me, it's like calling a coin flip right once, deciding you're psychic, and then betting your entire house on the next flip.
That's a great way to put it.
I mean, how does someone even recover from that level of public humiliation and financial ruin?
Well, what's fascinating here is that this exact failure is the cornerstone of his entire worldview. Usually when we make a massive mistake, the human instinct is to hide it or blame the market.
Right, sweep it under the rug.
Yeah, but he did the inverse. He used it to realize his own blind spots. And that led to his foundational equation, which is pain plus reflection equals progress.
Pain plus reflection equals progress. I mean, it sounds great on a motivational poster, but putting that into practice seems excruciating.
Oh, it is.
You literally have to catalog every single time you're wrong.
But he realized his unchecked ego could bankrupt him. So he needed to systemize his decision-making to protect himself from his own worst impulses.
And this is where his whole concept of the machine comes in. He starts viewing reality as this giant engine governed by cause and effect relationships that just repeat over time.
Yeah, because if you strip away the emotion from an event like a market crash or even just a hiring mistake and treat it like a data point, you can analyze the cause and effect. And then you write a principle for dealing with it next time.
It's like building an instruction manual for reality. And to make this work inside an actual company, he established what he calls an idea meritocracy at Bridgewater.
Where the best ideas win, regardless of hierarchy.
Exactly. A first-year intern can technically override the CEO, but to do that, he instituted radical truthfulness and radical transparency. People are heavily encouraged to speak candidly and openly point out mistakes.
Right, and they achieve this through something called believability-weighted decision-making.
Okay, I really need you to explain that one. Because whenever I hear radical transparency, my mind immediately goes to, like, the worst boss I've ever had.
Yeah, that's a common reaction.
I mean, isn't radical transparency just a fancy corporate excuse to be a total jerk to your coworkers?
Yeah. It really isn't about cruelty, though that is the biggest criticism. The goal is to eliminate the hidden agendas and office politics that destroy groups.
Okay, so how does believability weighting actually work then?
Well, think about how you make decisions. If you ask 3 friends for advice, you might go with the majority. But believability weighting asks what the actual track record of those friends is.
Oh, I see.
Yeah, if 2 are broke and 1 is financially independent, you don't weigh their opinions equally. You weigh their advice based on their historical ability to solve that specific problem.
So they're basically constantly rating each other's credibility.
Literally, yes. They use iPads in meetings to give real-time feedback on dozens of attributes. And all these human interactions get translated into data points.
That's wild.
Yeah, and the algorithm works alongside human judgment. It's a hybrid of human creativity and machine learning to filter out confident but inaccurate people.
Okay, which naturally leads us to how this machine actually manages money. Once you understand his obsession with preparing for what he doesn't know, rather than predicting what he does know, his investment strategies make perfect sense.
Right.
Let's talk about his flagship strategy, the all-weather portfolio.
The all-weather portfolio is designed around expected risks, not expected returns. He identified that the economy really only has 4 seasons.
Rising and falling growth, and rising and falling inflation.
Exactly. And since nobody can perfectly predict the next season, you need assets that survive all 4.
So what's the specific allocation?
According to our sources, it's 40% long-term U.S. bonds, 30% U.S. stocks, 15% intermediate U.S. bonds, 7.5% gold, and 7.5% commodities.
Wait, hold on. Let me do the math. That's 55% of the portfolio of bonds.
Yep.
But standard retirement advice is the 60-40 rule. Like 60% in stocks, 40 in bonds. Why does he use so many bonds?
Because of a concept called risk parity. You see, the traditional 60-40 model allocates by equal dollar amounts, but stocks are roughly 3 times more volatile than bonds.
Oh, right. So the stocks are driving almost all the risk.
Exactly. If the market crashes, 40% in bonds isn't enough of a parachute. So risk parity allocates by equal risk, not equal dollars. You need way more boring bonds to balance out the volatile stocks.
Here's where it gets really interesting. I look at this all-weather portfolio like packing a suitcase for a trip where you don't know the destination.
Okay, I like this analogy.
You pack a swimsuit and a heavy parka, you definitely won't use all of it. If you go to Hawaii, you're lugging around a parka, and you'll underperform the guy who only brought board shorts. But you are absolutely guaranteed to survive no matter where you end up.
That perfectly captures it. You trade peak returns during bull markets for massive protection during downturns. And it works. During the 2008 crash, while the S&P dropped 37% and average hedge funds lost 19%, Bridgewater profited 9.5%.
That is insane.
And their pure alpha strategy only had 4 losing years out of 32 from 1991 to 2023.
So if you build a machine that survives the modern market, the next step is asking if it works on a global scale. Which brings us to his book, The Changing World Order.
Right. He applied this analytical engine to 500 years of history, studying the Dutch, British, and American empires, and he sees a repeating pattern he calls the big cycle.
And he notes a terrifying confluence happening today. Massive debts, money printing, political and social conflict fueled by a huge wealth gap and a rising power challenging the existing one.
Specifically, China challenging the U.S.
Yeah.
And the last time this exact setup happened was between 1930 and 1945.
Now, a quick pause for you listening. We need to explicitly state our rule adherence here. He has called for the reform of capitalism and warned about China's rise. We're not taking any political sides or endorsing these views. We're merely impartially reporting the source's findings.
Absolutely. We're just looking at the output of his historical machine.
But relying on this machine brings us to the massive controversy here. In November 2023, the New York Times published a huge investigative report claiming Bridgewater's investments are largely based on his own personal stock picks and insider info from government contacts.
Right, not the sophisticated algorithms he touts. And we should note, he threatened a multi-billion-dollar lawsuit over this, strongly denying it.
So what does this all mean? If there's a bombshell report saying he's just picking stocks based on who he knows, can we actually trust the machine?
Well, if we connect this to the bigger picture, it's the ultimate paradox. But for you, the listener, whether the algorithms execute perfectly or his intuition guides them, his macro-level observations of historical patterns remain highly influential.
So you can critically weigh the principles separate from the man.
Exactly. You don't have to believe in the flawless machine to use risk parity or believability weighting in your own life.
That makes a lot of sense. So to summarize, we went from buying a $5 stock to nearly going bankrupt, to building an empire on radical truth and preparing for every economic season.
It really is an incredible arc.
The takeaway for you listening is to embrace your own failures. Ask yourself if your own life portfolio can withstand a sudden change in the weather.
And that leaves us with one final provocative question based on our sources.
Lay it on us.
If he is right that reality and history work like a machine, driven by repeating cause and effect relationships, do we actually have free will in our economic choices, or are we all just unconsciously playing out our assigned roles in the big cycle?
Oh, wow. That is definitely something to think about.